with survival of the fittest is fading out, we welcome everybody for our fourth webinar in the Survival of the Fittest series. This time the focus is on equity analysis, and for the first time we're gonna have an external presenter to provide some insights to how the model. We have a commissioned analysis from Västra Hamnen Fondkommission, and their chief analyst Alf Riple will tell us a little bit about how the model is built up. I don't think it's sort of common knowledge for everybody. It produces a really very comprehensive view of the value of the company, and it always comes out every, I guess it's, if any big events has happened, but also after each quarter, it normally does an update. But I think few understands the work that has gone in, and I think it is good to understand what is happening. So let me sort of leave the floor to you here, Alf, and see what you could help us with understanding of how this all works. Let me go back to sharing my screen again. And the first slide, Alf, over to you.
Yes, thanks very much, Joachim, and thanks very much for giving me the opportunity to do this. As you said, we put a lot of work into trying to understand the economics of Crunchfish and put that into our very big and comprehensive Excel model, and then we write these reports usually 4 times per year, where we try to explain how we're thinking about the value of the company, really. So yes, as Joachim says, I work for Västra Hamnen Corporate Finance. I'll give you a presentation of the company later on. But in a picture that's in front of you, you see our latest, the latest cover of our research report that was out in the beginning of December. And as you can see, just from the top there, we also indicate what we think is fair value for the share at that point in time. And when I say we, that's myself and my colleague Jens Jakob Ober Nordqvist who produced these reports. Also, I've included a web address in the bottom there where you can see where you can find these reports. Crunchfish puts them on their investor page. There's a headline called Commissioned Research. There you can find all of our reports. You can also, of course, find them on our own website at VHcorp. That's VHcorp.se. But if you flip the page, Joachim, I want to make one thing very, very clear. Our research does not attempt to guess where the share price is trading at any point in time. Instead, what we want to do is we look at the economics of the company. We try to make an assessment of what you can expect or what the company can expect in net cash flows in the future, and we try to convert that to a value of the company that you would pay irrespective of kind of market conditions we're having. As you all know, the markets, and as we've seen especially this week, markets can go up or down for psychological reasons or whatever reason. And of course, the Crunchfish share will trail in the general market trends. We do not try to guess which way the market is going and whether there are geopolitical conflicts or stupid tweets from stupid presidents of big countries, things like that can affect the market in the short run. We try to look through all that and look at if you take a long-term perspective, what is the underlying value of the company? So that's the whole point of us trying to give a value estimate for the company. So, but how do we work? Well, into our big Excel model, the first thing and the most difficult thing is to try to estimate what kind of revenue streams the company will be generating over the forecast horizon. And we take a fairly long-term view. We try to be specific about our expectations for a decade or so. So for Crunchfish, our model goes all the way up to 2030. And as you can see from the chart here, the revenue streams, we expect them to go up. But what is also very apparent when we look at Crunchfish, we look at each of the business areas, digital cash and gesture interaction is the first one that is really dominating our expectance of income streams. And that is not because we think we don't think gesture interaction has a big value. It's just that we don't see yet the kind of consumer solutions where gesture interaction will really come into its own. We think that digital cash are much closer to come into reality, and that's why we have put a higher probability on it, and that's why it also dominates in this picture. So if we zoom in on our projections for revenues from digital cash only, how did it come to land at those high numbers that you saw in the charts? Well, first of all, we're trying to assess the long-term potential. What we did is when we wrote this report, last time we updated our model, we zoomed in on the offline solution for digital cash only, because that's where at the time we thought we had the best data, and we started thinking about, okay, how many people could potentially use the solution if we look at it globally. So we started looking at how many payment cards are there, how many digital wallets are there out there, and we found this number in the area of 15 billion globally. So of course, many people have more than one payment card. I do, and if you relate the 15 billion number to the about 5 billion people in the adult population around the world, it's obvious that a lot of people have more than one payment option. But it's not clear that they would choose more than one offline digital cash solution. Maybe it would just do with one. But we decided to be even more conservative. We said that, okay, let's say the potential, the addressable market is one of every two adult around the world. So that would be an addressable market of around 2.5 billion people. So these would be the potential customers. Out of that potential, we said that in the long run, maybe Crunchfish could reach out and capture the wallets of about 2% out of those 2.5 billion people. So that would be roughly 50 billion people who would pay the bank to have a root certificate which enables offline digital cash payments with a phone. So how much would these 50 million people pay to have the privilege? Well, again, we looked at payment cards. We found that a lot of payment cards charge something in the area of $20 or 200 SEK per year. So we thought, okay, again, we're going to be conservative. We said that maybe they were going to pay 50 SEK per year. So multiplying that, we come to a potential revenue for Crunchfish in the area of 2.5 billion SEK per year when they have reached the 2% penetration rate. Then, of course, if we're going to be honest, there's no certainty that Crunchfish offline solution is going to catch on a wide scale. So we decided to risk that. We say that, okay, maybe there's a 50% chance that this is going to become a global, big, and a popular solution. So we decided to take all of the cash flows that or all of the revenues that we did in the first calculation, we're going to divide them by half. So instead of 2.5 billion in 2030, we decided to include 1.25 billion in our model for that particular year, and the same for every other year. When we have the revenue streams, we have to convert that into what we really put into our model, and really to what we're really trying to weigh and accumulate in order to arrive at the value for the company. You know, the company doesn't get to keep all of its revenues. It has a number of outlays that are also necessary in order to run the business. So there are always things like operating expenses, taxes, and investments. So operating expenses in the case of Crunchfish is mostly salaries and other personnel costs. Taxes, of course, is the corporate tax. And investments, that's also in the case of Crunchfish, that's usually development costs, but on some investments in working capital. But taking that in combination, we're at the free cash flow, which is really what we're looking for. And if you look at the chart, you see there's a big difference between revenues. Those are the risk-adjusted revenues, as I said in the previous slide, where we have divided the potential revenues by 2. There's a difference between free cash flow and revenues. And free cash flow in this particular case is something in the area of 60% out of revenues, if you look at the far end of the chart. That there's a big difference, but this is really very, very high compared to a lot of other industries. I mean, if you were looking here at a typical industrial company or a car producer or something like that, free cash flow would be probably less than 1/10 of revenues. And that really goes to show the scalability that comes with a business model that's based mostly on software. We don't have a lot of variable costs when you produce software, and an additional customer don't really bring a lot of extra costs to the company. And that's why you can have a fairly high free cash flow in relation to revenues, and that's really the scalability and the attractiveness of the business model. So to put all these things together, we have beyond the 2030 that we have tried to forecast in some detail. We have made an assumption that the free cash flow is going to grow forever by 2.5% per year in eternity. This is the common way of modeling. You model a company as if it's going to grow forever. Then we take all of those free cash flows from here to eternity, and we calculate what the equivalent value of that would be in today's money if you discount it by a fairly tough discount rate. So what we're really saying is that an investor would like to have 18% return on the money if they invest in Crunchfish. That's why we count back. So for every year into the future that a cash flow is due, then for every year we discount that cash flow by 18%. So we take away 80% per year into the future in reality. So the farther into the future, the less $1 or 1 krona is worth. And then we combine all these future cash flows, positive and negative, and we arrive at an enterprise value that's in the area of 2.7 billion for the whole company. Now we're not done risk adjusting yet, because we also have a method that goes for all of our companies that we do research on, where we say that, well, that 2.7 billion, that is what it was worth. We knew that already it had passed the hurdle to become a company with a sustainable profitability. So there's also always a risk that the company would not survive until it's reached that stage. And then we're trying to assess what is the probability that they will actually survive that long. And in the case of Crunchfish, this is a very, very, very difficult decision to make. But in the case of Crunchfish, we have decided that maybe it's in the area 50 to 80%, and then we calculate what the company is worth in either end of that spectrum. So in the first case, if there is a 50% survival chance, then we come to an assessment of a fair market cap of 1.4 billion Swedish krona, which would equate to 41.60 SEK per share. And if we do the 80%, the company would be worth 2.2 billion, which would equate to 66.2 SEK per share. So that's basically what's going on in our assessment of the value of the company. And as I said, this is irrespective of kind of mood we're having in the stock market at the time of assessment. Yeah, I think I just have one final slide that's that shows a little bit about our firm. As I said very briefly at the beginning, Västra Hamnen Corporate Finance is a small corporate finance advisor. We're located in Malmö, and we also have an office in Copenhagen. We do capital acquisitions, that is mostly listed companies who need new investors. We try to combine those investors with the company and see if something can happen there. We do M&A, so we have companies with acquisitions or maybe the sale of parts of the company. We do equity research, that's what I'm doing, and we help companies by acting as certified advisors for companies listed on First North. So we try to bridge the gap between growth companies and venture capital, and we help bring about healthy and successful companies. So, and our track record shows that in the last 10 years, we have helped raise in the area of 4 billion SEK to get companies off the ground and help them operate to the best of their abilities. That's basically us. So I think I'm going to give the word back to you, Joachim.
Excellent, Alf. Thank you so much for a very crisp presentation that I think provides a lot of insight to how your model actually works. I really think that was very, very well appreciated. So let me turn now to, I'm going to stop the screen sharing and let's see here. There we go. And we're going to start looking at having people asking questions. I don't know, Eric, have you been following sort of people here? If there are coming, have been some questions. Maybe only one question so far.
Yeah, so far it's only one question, and I think I can actually answer that. Alf, you need to confirm it, but in terms of the financing for Q4 2022, it says 18 million Swedish crowns. How did you get that number? I believe it's the that you discount 30% from the share price today, that the warrants would strike on a share price or at a share price that's 30% below the current share price, and that would end up in 18 million. I think that's correct.
Yeah, exactly. What we did is what we looked at what the share price was at the time. So assume that it wouldn't go up or down. If it were to trade at that same level during the execution period for the options, then the strike price for that option would be 70% of that stock price, and that's how we ended up with the 18 million. But exactly as the Oscar says, that there's a pretty wide range. It could go all the way up to 64 million.
And then we got the question around digital cash online and whether that was included in the valuation in your model. Could you elaborate on that, Alf?
Absolutely, yeah. No, I think I mentioned that in the presentation that the cash flows in our model, it does only take into account the fixed fees that we think that people will pay to get access to the offline mode. So any fees that would incur from online is not yet in the model.
I think that's a question I could ask you, Joachim. If you could elaborate a little bit about the transaction, how we look at a cash flow from the online offering.
Yeah, I think it will, as Alf, the digital cash offline would very likely be a subscription model. You pay per year, just like Alf have it. And it's similar to the card, how banks are charging for card services. Digital cash online will much more resemble how banks are paying to get services like a switching service that they have. They need a switch in order to route payment from accounts to payment services. And that model is much more transactional based. And I believe we will also have a transactional based model there. So this is something that Alf would look at and include maybe in his update that is coming after we release our Q4 report. If you remember, we just announced really digital cash online, it was just when we released the Q3 report, and I don't think there was much time for Alf to sort of add that whole component. And there was some uncertainty as well at that point, exactly how we would charge for it. So I think it was wise. I think Alf always tries to be a bit conservative, so let's not include that revenue stream at that point. But I think now, and certainly in our discussions with banks and so on, they are, I think we have got clarity in our own mind, at least, how we would like to charge for this, which is similar then to how payment switches are charging for their services to the banks.
But if I'm allowed a question as well, who would you expect to be the final payer of these transactions? Would it be the users or the banks themselves? And I mean,
it would be the banks. It would be the banks, or possibly, digital cash online could. I think the majority of the cases will be. This will be a function that sits at the bank in order to give them that load balancing and stability and all that. Having all payment rails coming into digital cash online in the bank, so they would pay for it. I don't think they would pass this cost on to the users at all, but this would be a back-end cost for the banks. As I've described a few times before, they could do this without even telling the user. This is sort of a back-end thing for the banks in order to get that stability, load balancing. So they would pay for that service. Digital cash offline is different, because there the user needs to reserve out digital cash to their phone to be used in an offline mode. So the user is very much aware, and they are the one who benefit because they can pay without having internet connectivity. Digital cash online is a different matter, where we're helping the banks to be much more stable as we isolate away the core banking system.
Mm-hmm. And have you looked at other types of fees or payments that the banks are charging each other?
Yeah, as I said, payment switches. We talked to some company who do payment switches, and they tend to set up the bank for a multi-year contract, maybe 5 years, and that buys them in a lumps, in sort of a one batch, a certain amount of transactions as well, which needs to be consumed, say, within the first year, and then all the additional transactions over that, what this initial or this 5-year fee have bought them, will be per transaction over these following years. That's typically the model that so this could, with that model, which I think it is an accepted model in the industry, I think we will get revenue much earlier into Crunchfish, because we will actually charge banks for a 5-year sort of setup here, and having them to pay upfront for I don't know, maybe 1, 2, 5, 10 million transactions as well. So I think it will be attractive, but again, we're not at that stage of yet setting it exactly, but I think the model exists in the market. The banks are paying the switching companies for their service like that, and I think this is like a switching service as well that we are adding to the banks here.
And would you get to keep all of the transaction fees, or are there other players involved that you will have to share those fees?
No, this is completely our business, so there's no sharing with anyone.
I'd like to get back to the core of the topic of today. I'd like to ask you, Alf, if you're an investor looking at Crunchfish, and you would have a number of tools to look into the company. You would have, our company presentations. You would have our Q reports. You would have our website, and you would have the commission analysis. What part of how should an investor utilize your report best way possible? What would be your recommendation to an investor looking at the research? How should they look into it?
Well, I think the key to the value of Crunchfish is really that there is a huge potential market out there. So the question is only like how far and if at all Crunchfish is able to capture that opportunity. So that's really what you have to look at. I mean, ourselves, whenever you release a quarterly report, we almost forget that there's some numbers attached to it in the back, because I mean your day-to-day costs and income are really not that important. So you can almost look away from that. The really interesting thing is trying to delve into your press releases, to what you write in the quarterly reports, and also in our interpretation of these developments in the research, and trying to assess what is the chance that this thing is really going to happen, that you're going to capture a huge chunk of the future infrastructure for payments. So I think that is what we try to do first and foremost when we look at Crunchfish. We try to all the time keep the thoughts running on how big is this opportunity? Yes, it's big. What are the chances that you're going to capture it, and what are the steps that bring you forward towards that goal? So it's kind of a qualitative answer to your question, but that's how we're thinking, I guess.
I think it's a great answer.
Yeah. No, I agree with you 100%. I think the levels we are right now, certainly in terms of revenue, certainly doesn't warrant any. What did you have? 2.7 billion valuation. So you know, a little bit here, and you know, it's not here. This is a play for the future, really, that we can scale up and capture the market. We are quite bullish ourselves, as you know. We are talking about that we are the future of payments. We think we are, with our model, how we add substantial benefits to banks and payment services, and regardless of what they are, you know, card or instant payment, crypto, or even CBDC, we think that has enormous value in the market. And we just have to break through now and get our service out there, but we're getting closer. I know that's some of your risk adjustments that you do on us, Alf, is that well, you're not out there yet, and I think that's very fair, but we're getting closer, and getting closer, particularly in India, which is sort of the biggest market in the world right now for these kind of payments. So it's very exciting times.
No, I agree.
I had one question. I think maybe it's a little in depth, but I'd like to ask you, Alf, when you have the 2.5% growth forever in your model, how do you come up with such a number, for instance? Do you look at tech companies in general, or is it more what's the fundamentals for the number behind it?
I think in our models I think we have a great variation of different growth rates for different companies. I think we vary between 2 and 2.5%, and you know, I guess the anchor point for that assumption in a model is really what is the in a normal long-term perspective, what is the growth rate of the world economy? So that anchors it to about 2%. And then since you're in the tech business, yeah, well, tech has shown a much higher growth rate historically. So probably even in the long run, and even if we look generations forward, tech is probably going to show a higher growth rate than let's say an industrial company or a healthcare company or something like that. So that's why in this case it's 2.5%. I have to be honest with you. If we choose 2 or 2.5% in the case of Crunchfish, it doesn't make all that much of a difference in the model, and that's because this is pretty far into the future, and we have that hefty discount rate of 18%, which means that something that happens 50 years from now, it weighs very little in the model anyway.
Yeah, essentially, Alf, you have a ramp-up model that we ramp up as you have up to 2030, and then since then it will just be, you know, a steady state, a 2.5 growth really. But that's sort of what you do, and I guess that ramp-up is all about it's all about then assessing the probability that we will be able to ramp up like that. That's what you had at the end, wasn't it, with 50% or 80%? I have a question for you, Alf. Given that and you write that as yourself, that we may not need any more capital. This question that came earlier here, that at the end of 2022 we will get another cash injection thanks to our warrants that will be exercised in December, and that probably means that we don't need more capital. But how does that affect these probabilities for survival? Because obviously, if you have if you need capital, then there's always a risk you won't survive because you didn't get the capital, you couldn't find it. But now, as we starting to agree on that, we perhaps not need more capital. What does that mean for those probabilities?
Oh, that's a great question, and that is it's not easy to answer it either, because I mean, obviously a company can live forever if you just keep pouring more money into it. So that's really not what we're thinking, because that would be a nonsense scenario, really. What we think when we do this calculation is this company, the question we're really asking when we come up to the 50 and 80% is this company going to be profitable anytime at all? And what's the probability of that happening? And then when we have decided that, we just leave it there. Then we do our scenario for the short term, because capital acquisitions is usually in the short to medium term. So we see if the scenario plays out that you have this income and these costs in the next 2-3 years, do you have the cash to keep it going? And a little bit irrespective of the first assessment there of the survival chance, do you look like you need money in the next 2 or 3 years, or do you think does it look like you're going to start generating cash to keep you growing without further capital acquisitions? And that's the case right now, that the model says that now this cash is going to suffice, because we see revenues starting to increase in earnest late this year and into next year. But these things they're very moving targets, and it's not uncommon that when you do models like these, that you have to rethink what you think about the capital needs. But I mean, that's what the model says right now.
Yeah. And I guess what could happen, and I know you've done it before, is that you will adjust some of these risk factors as given what we write, as you said yourself, what you read carefully what we write in our quarter reports and press releases that come out, and that affects sort of some of your assumptions here. So this is a moving target, or this is not a fixed model that will stay like this forever. This will change.
The cement does never dry.
Yeah, the cement never dries. Excellent. Any more questions for Alf and the panel? Otherwise, I think we should move over to the last session, which is this co-create, discussing about how we could make things even better. I think they came in the last minute here, Eric.
We had a question from the audience, which says, what's the USPs with our payment solution compared to other companies' payment solutions, and if we know any other companies who are working with a solution that's similar to digital cash, or is developing a similar solution to the digital cash?
Maybe I should take that. I think we are very unique in the way we have set it up. I think yesterday we announced our sort of second, it's not a patent yet, but it is like a patent. It's a very clear recommendation that we will get another patent here in the area of digital cash. And what sets us apart is that we're not a payment service. The way we go to market with it is that we're not a payment service per se. We could actually now, when we have online and offline, and we're going to develop this also on smart chips as well, we could go out and become a standalone payment service of our own. But that's not the plan. The plan is rather to complement any other payment service with the features of digital cash. So we will add digital cash to banks or payment services in order to improve on their services. We'll make banks more robust. We can help them to load balance. we can, with if we talk about instant payments like Swish we have here in Sweden or UPI in India, we can make that stable. That's not very stable today if say a bank has gone down, or maybe you don't have connectivity yourself. We bring additional features. I recommend you to look at the previous webinar we did on digital cash benefits, because that talks about all these benefits that we add to payment services. And I don't know about any other companies who is sort of going to market with the comprehensiveness of what we're doing in this area. I think there are bits and pieces with other companies so that they improve a little bit here, a little bit there. But we have now, with digital cash platform that we have coming to market, we have the entire architecture that will be, I think, extremely important in order to bring digital payments into the future. Next webinar will be on CBDC, which is really quite interesting because that has extra requirements on payment services in order to try to replace what cash represents in the market, and that is that's going to be very, very, very important. And I'm going to talk about that to give you a good feel of what do we bring to a play like CBDC. But it could be anything. It could be crypto, it could be instant payment, it could be card payments. We really bring substantial value here, and I think there's few competition at the moment for this.
We got a follow-up question to that, and that was in our negotiations with banks and customers. Maybe we've seen any other company that will be competing with us.
Not really. I think I think I'm not sensing that they are looking at other things. I think we're bringing something which is quite groundbreaking and really they're pleased to see it. Again, there are bits and pieces. So like, we're very happy that RBI in India, for instance, they have now come up with a regulatory framework for offline payments. So there are various forms of offline payments for segments in the market. I think that exists. But I think the comprehensiveness of our solution of going all the way from online to that the bank can then issue offline services, and then we can also have non-mobile devices as well, like cards and variables. I think that's second to none that we've done in this area, and I think that will attract banks primarily, as I said, but also it could be payment services as well. That because we can equally hang the entire digital cash structure under a digital cash online, sitting at the payment service also, because this is a whole architecture hanging from digital cash online, and then you have digital cash offline, and then you have these cards and wearables who's also handling digital cash.
All right.
So, but let's a few minutes on this co-creation then. Is there any ideas of from the audience here? Can we do anything better with the equity analysis? Do you read it? I know there's people here listening in, and are you using it? Is it value to you, or is there something you are missing, or this is sort of can we do anything better? I think you have the perfect report, Alf. People are just shy. We think as Crunchfish, the reason why we do it is that we think it is a very valuable service. We are a very difficult company to analyze. It's not easy to do, and this is a service that we pay for on an annual basis to Västra Hamnen and Alf Riple's team to come up with this, and we do it not for our own sake, but really as a service to the stock market. That's why we do it. We wouldn't get any analyst from we're too small for any of those analysts from big banks or anything to follow Crunchfish. So this is just the way it is in the market, and but we think it's valuable, so that's why we have decided to have this service. I don't know, Alf, is that similar as you see in that people are doing it for this reason, that just to give it as a service to their shareholders, or what have you heard as reasons why people want to have equity analysis?
Yeah, I think it's basically the same thing that brings companies to to services like ours, that they think that the market, the general investing public, they haven't really understood what the value drivers is in the company and what the value proposition is, what they can, what the true nature of their opportunity really is, and that's why they want somebody to tell who are outside of the company looking in. Man, you can stand on a soapbox and shout to the world that we have all of these opportunities, but what we do is we listen to you, but then we look at a lot of third-party sources as well and say, well, is it reasonable what they're saying, and try to be open about what we think the opportunities are, what we think the risks are, and if the scenario plays out, what's the value of the company? Because and that last bit is something that you can never do. You can as a company, you can say what the opportunity is, but you can't go and tell the market what you think the value of the company is. So that's for that you need somebody, and that's a role that we are happy to take. So I think that's the main reason why people order commission analysis. And I also would like to say that we feel the same kind of commitment as you do to the investors, because even if Crunchfish is the one who orders and pays for the service, our real stakeholder is the reader, really. And we want to be we want to have a commitment to the reader that they can trust. That when we say that something is in a certain way, then we have checked that it is that way, and we say that something is our guess, well then that's our guess, and or our judgment, and we want to be very clear and that those things never get mixed up. If something is a fact that can be verified, then we'll say so, and if something is our judgment or our guess, then we will say so. So it should be pretty clear what are our judgments and what are actual facts.
We got one question, Alf. This is for you. In comparison with other companies that you have analyzed, how good is this sort of innovation? I guess if we talk about digital cash again, the digital cash innovation in relation to the company surviving. I don't know. That was the question. Sort of. How do you view the innovation of digital cash really for our? Yeah.
Well, I don't think it would be fair to say, and it's really difficult to rate the quality of different innovations. But I would say that the standout thing about Crunchfish is that the market is extremely big. So there's a lot of risk, as I've shown you. We have to apply a lot of risk factors in trying to translate this into value of the company. So there are plenty of risks, and one of the risks is that some of the market that you're going for, it doesn't really exist yet. The offline payments isn't a thing yet, or basically isn't a thing. So that I would say that in comparison to a lot of other companies that we analyze, there are bigger opportunities and also bigger risks. That's how I would sum it up.
Yeah, thank you. All right, so let's, if I move back then to the presentation, let me see here. I share my screen again. Just trying to provide a little bit of an view on what's going to happen in February. There's always, we run always these webinars in a cycle of 4. Every second one is digital cash. So it's going to be digital cash again, looking at CBDC at 4th of February. We're going to have gesture, and we're going to look at the exoskeleton platform. And then it's going to be digital cash, and we're going to talk about Viki, who's really a key player for us, who have developed our secure environment for our on the mobile phone, as well as that they are helping us with our distribution in Southeast Asia. And then we're back to Crunchfish focus again, and it's going to be you, Eric, who's going to present on investor relations at the end of Feb. But next time, sort of on the 4th of February, it's CBDC. It's going to be myself presenting. The panel will be Magnus Lagersson again from Swish, as we had at the first webinar, and it will be Gagan Koshar as well from India. So that is the plan that we will have. And maybe, someone else has shown up here I can see that on my screen at least. Hello, Johan.
Yeah, next Friday I will join you from 8 o'clock. Is that okay, Joachim?
Absolutely. No, I think I got complaints that I'm playing too. Even my wife complains that she sees me too much on this webinar. So I think that's you have to listen to your wife, obviously. So Johan will take over as the moderator for the webinar series from now on.
Yes, and I will definitely bring a perspective because I'm not into really your area, so I will ask you the stupid questions. What are you talking about? And if you tell this to my mother or my 10-year-old daughter, how would you describe it? Those kind of questions, but otherwise it would be too nerdy, and I need to understand because I will try to drive the conversation in some way. So from now on, I will join you on Friday mornings, and I hope you will participate if you are following this from wherever we are in the world. Because the questions, I think they are crucial because we have a lot of answers, I know, and a lot of eager to tell the world about these, these new of using digital cash. So it's important that we bring all the stupid and bright and all questions so we can understand and follow what's going on. And also for development, I believe, because you need to know where the obstacles are, where you need to tell the story in another way, etc., because this is a journey I realized. So from now on, I will be participating for a while at least. So if I get my earphones right. So I'm glad to be with you.
Very, very welcome, Johan. I think you do an excellent job. I think it will be good. I think it will just raise the quality of the webinar. So very welcome to the webinar series, Survival of the Fittest.
Yeah, well, it will be great.
Yeah, absolutely. And with that, I want to thank the panelists, Eric, but not least sort of Alf, did an excellent presentation. Thank you so much for sharing your views. And I would like to welcome you all back for next Friday, when the focus is going to be on CBDC. Thank you very much.
Thank you.
Take care. Bye-bye.